Now, technically, I'm not supposed to be here while you fill these things out, but this class is the template for the new book. So you have to do this seriously. Mostly we take these things, we don't read them, we throw them away, we worry about to change the course. But this time you have been the victim of a lot of new material, and mostly if some of it seems to be badly conceived, we need to know that. If you want to take them back and...
No arrows.
People still doing them? Evaluations? Okay.
Hey guys, if you haven't filled it out, just find me after class.
Lots of luck with that.
I'll be over here.
There's this guy up here. Are people still writing their evaluations? All right, for the last 3 of these classes, you are going to get to see value investing in action. Now, the first 2, which is today and on Thursday, are in a sense bookends for styles of value investing. At one extreme, you can do quantitative, not just low market to book and so on, but well-conceived, widely diversified quantitative models. And what the people today are going to present is really what I think is as good an approach to that as anybody. At the other extreme is to do very focused, very concentrated company-by-company analysis, which means that you're going to have a portfolio of probably 20 positions or less, except maybe for some seed positions that you just want to track. And that's also an important skill here. But those are the 2 bookends of the way you can approach things, and presumably you will pick a style for you that integrates both those 2 approaches and meets somewhere in the middle. The last class, by the way, is something that we should do but have not, which is we have probably the leading fixed income multi-asset approach value investor coming from Los Angeles, who is Mitch Julis, who is in the process of writing a book himself, so a lot of penetrating questions would help him a lot. So that's just applying this to a broader class than just the equities that we've been evaluating so far. So that's how we're going to do things. Today's speakers actually have extraordinary pedigrees of their own. So first is Judd Kahn, who you may recognize from the book, who is there. The second is Jenny Wallace, who was in the first value investing class, which I think consisted of 45 people. She remembers 30, I remember 50, say 40, who also worked for a long time with, and very successfully with one of the leading value investors, who was the person that Warren Buffett picked to run the Fireman's Fund, who is Bob Bruce, and has gotten involved in this also. And finally, there's Artie Williams, who some of you probably know as perhaps our finest value investing teacher. So with that, I turn it over to them.
As Bruce said, I'm Artie Williams. In a minute, I'm going to introduce Judd and Jenny to you. But we represent Summit Street Capital Management. We run a portfolio of stocks that we select on the basis of value, quality, and financial strength. Everything we do, from sourcing our ideas to researching our candidates to managing our portfolio, is structured to ingrain best research practices and management practices. But before we do that, we've got a little exercise we want each of you to do. And I think, did we pass out the index card?
You pass them out?
Yeah. Yeah. Okay, we've got 3 questions. On your index card, I want you to list 1, 2, and 3. We're going to go quickly through these. And for those who can't see the board, see the slide, I'll read it to you. This is not a test. Everybody ready? Okay, a bat and a ball together cost $1.10 in total. The bat costs $1 more than the ball. How much does the ball cost? Okay? Question number 2. If it takes 5 minutes for 5 machines to make 5 umbrellas, how long would it take 100 machines to make 100 umbrellas? Ready to go?
Yep.
And finally, in a lake there's a patch of lily pads. Every day the patch doubles in size. It is completely covered on the 48th day. On what day is it half covered? Okay. Then you pass your cards into the center, and then we'll have somebody pick them up here.
They get these from a young graduate.
what we're going to talk about today is how we use value investing theory as our starting point, why we use it as our starting point, and how we apply it in real world practice. But before we do that, I wanted to introduce my partners, and they can tell you a little bit more about themselves than Bruce did. Jenny, why don't you start?
So I'm Jenny Wallace. In fact, all of it I was going to say Bruce has already said, which is I was in the first value investing class, and boy, were things different then. The program was one class, if it could even be called a program. I really think there were like 32 people in it, and probably 5 of them had to be convinced to take it because value investing just wasn't what it is today in terms of, at least within the business school population. And I think Bruce probably tells you, Warren Buffett says it, that value either resonates with you in the first 5 minutes or it never resonates with you. For me, it was clearly a superior approach. Sorry about that. But I had been in investment banking and corrupted before business school by that. I then went to consulting after business school, and at Bruce's urging, ultimately came over to the good side to value investing from a investing standpoint, and worked for Bob Bruce. And it is with Bob that I really learned what I think we're going to try to talk to you about today, which is how to take value investing theory, which you get to learn here, not only in this class, but also in all the other classes that now make up the program, and how to take the theory of value investing and really apply it in the real world. So we're going to spend time with you today to talk about that. Let me introduce Judd. Can you guys hear us okay? Do we need the mic or no? Okay.
Hi. I didn't take the class. I didn't enroll in the school. And it's only recently that I've gotten to call myself a value investor in practice. My route is a little bit different. I was teaching in the early 70s at Wesleyan University in Connecticut. I was in the history department. I had friends in the economics department, the political science department, even some in the sociology department. They housed us all together. And I think it was 1973 that the economics department made a terrible mistake. They hired this young guy out of MIT that ought to have been a giveaway. And he showed up, and he was fun to talk to. He was a lot more interesting than all the other dullards there. You may find this hard to believe, but he actually had opinions about things. And we got to be friends. So he left, I think it was 1977, for what he likes to say as the labs, which meant Bell Labs in New Jersey. So far as I can tell, Bell Labs had physicists who worked on the hardware of information technology. They invented the transistor and a lot of other stuff. They had software specialists who invented the Unix operating system and lots of other stuff. And they had economists. And I think the role of the economists were most of the time to write very high-level papers. I think that's where Bruce first collaborated with Joseph Stiglitz. But basically, I think the role of the economists there was to justify the rate increases that AT&T, as a regulated monopoly, was always asking for approval. Is that unfair? Or that's it? Okay. So Bruce was at the labs, and I left Wesleyan for other reasons, and we lost touch. And then one morning in 1992, before CNBC existed, before there was anything other than Louis Rukeyser basically on television, I turned on the set one morning, and on a Sunday morning, and there was, Bruce Greenwald talking to Consuelo Mack, was that it? As the Robert Heilbrunn Professor of Asset Management at Columbia University. Bruce did not have an unlisted telephone number, so I was able to get in touch with him. And we got reunited, and we stayed in touch for a while. And then in 1999, he gave the first 2-day version of this class. It was a very sleety January day. He asked me if I'd like to come. I said, sure. There were about 30 or 40 people there. Everybody wrote down their names on one of those little triangular things that you use when you have those seminars. And that was it. After a break, some guy had left, but he left his name card behind, and his name, he was clearly the scion of one of the major investment banks in New York. And who also was at the event was a reporter for the New York Times who noticed that, and a week later wrote up a little article about the course describing Bruce as the guru to Wall Street gurus. Now, none of you have heard that expression ever since because it just died stillborn that morning, right? But it was a very fortunate day for me because that day Bruce got 3 phone calls from publishers wanting to know if he would be willing to do a book on value investing. And he made, I think, the wise choice for both of us to bring me in. I was delighted. We did that book, and then I had the pleasure of doing 2 more with him. And it's been very educational. A lot of honest faculty will tell you that they never understood the material in the course until they had to teach it. I think it's even more true that you never really understand it until you have to do a book about it. So all of those things have been very important educational experiences for me. And I landed in Summit Street fortuitously by sharing an office with Artie and Jenny when they were doing something else and I was doing something else. And then just by happenstance we started to talk about running a fund that looks miraculously like the one we're running now. It took us about 2 years of research to get it going, but it's up and running, and we're going to tell you more about it. And that's how I got to be here, and now Artie's going to tell you how he got to be here.
I actually worked in the real world for a while. I was in the, after graduating from college and majoring in accounting, where I learned that you hire accountants. I went to work for my family business, which operated convenience stores and truck stops in the Southeast. And I did that for 20-some-odd years, but was always interested in finance and investing. And I read a Wall Street Journal or New York Times article about this course taught by the guru of the gurus on Wall Street. So I attended the second class, which was held in, I think, June of 1999. And we're sitting at a table at lunch, and Professor Greenwald is there, and he goes around the table, and he said, "Where did you go to business school? And where did you go to business school?" And he comes to me and says, "Where did you go to business school?" I said, "I didn't." And he said, "Where did you go to undergraduate school?" And I said, "University of North Carolina." He said, "Oh, that's a great school. My brother went there. But you ought to go to business school." Well, after sitting through the course for 2 days and not understanding a thing that was going on, I decided if I was going to do this for a living, I probably ought to go back to business school. So I applied to school, was accepted at Columbia, and in my second year, I sat in on this particular class. Now, I was in the IMBA program, so I was commuting back and forth, but sort of the genesis of what we're doing now started in that very class. The very first class, Bruce stood up and shows the chart, which I'm sure he showed in this class, where you have the 10 by 10 matrix, where you see that small and value outperform. And he said, if you follow a low market-to-book strategy, you'll outperform 90% of all investors, and you'll probably outperform 90% of all the people in this room. So that always stuck in the back of my mind. And then I guess a couple of 3 years ago, Judd and I were talking about some things, and he had an idea of starting a fund called the Barge Pole Fund, which is you would invest in these crappy little stocks that you wouldn't touch with a barge pole. Sort of a statistical approach. I then later read a book titled Super Crunchers by a gentleman by the name of Ian Ayers, and we sort of put it together and said, with the power of computing and the software that's available, why don't we try to do something that's a little more statistical in nature than what we've been doing before? So we started to work on that. We took as our starting point Bruce's challenge, and we kind of jokingly referred to it as the Greenwald Challenge. And so that's our starting point, is the low market-to-book strategy. Judd's going to spend some time to explain more about what that benchmark is, but that's the basis of it.
Yay. Okay. I remember the Fama and French article as being filled with tables, Greek symbols, and other things that I had a very difficult time understanding. But I also remember that if you chewed your way through it, it had some enormously important insights. There had been other studies, I think, before that 92 article of theirs, but this was probably the first one with a lot of statistical solidity to it. And it said that if you pick stocks with low multiples, value stocks, that, as opposed to glamour stocks, you would outperform. They used a book-to-market calculation, and that's what I'm showing up here. There are others. You can use price earnings. You can use price to cash flow. I don't know that you are aware of this, but Ken French publishes monthly returns for all of these measures on his website, and he's extended the time series for the book to market back to 1926, and for the cash flow and the price flow to market back to 51. So if I remember the original article correctly, it went from 1960 to 1990. And if people with more statistical knowledge than I have will tell you that longer time series give you more confidence in your findings. So they've been very helpful. So here's what you get if you just look at the book to market, divided it into quintiles, which is a very simple thing. It's on the website that French supplies, and what you get. And what you see, of course, is that the cheaper end of the spectrum on the right-hand side outperforms the others, and it does so in a stair-step kind of fashion. It's pretty hard to misunderstand what's going on here. Now it turns out that if we switch from book to market to earnings to market, lo and behold, it looks very much the same. Very hard to distinguish between the two. And finally, when you get to cash flow, another chart that's parallel to the first two. I did the amazing thing of putting them all together, and it's hard to distinguish which one is which. What we know is investing in stocks at the left-hand end, the stocks with high multiples, is a good way to not do as well if you invest in stocks on the right-hand side. The black line represents the market return over this period. I may have put it in the wrong place. It probably should be around 8.5%. I had to draw it in because I wasn't sophisticated enough to get Excel to put it in to it. So this is a stair-step progression. As you go from the most expensive to the least expensive, your chances of success get a lot better. So we decided, why would anybody start anywhere else, you know? If that gives you that kind of head start, that's the place to begin. There's one more chart I want to show you. These are two portfolios. They both start in 1951 and they end in 2009. They both do well. Portfolio B, which is the red one, has a return of 15.8% a year, and it turns $100 into $539,000. But Portfolio A has a return of 19.6% a year. It turns $100 into $3,592.66, and I've left off another numeral here, but that's $3 million. It's 6.5 times, 6.7 times the other portfolio. Now, what's most interesting is these portfolios hold exactly the same stocks. The blue line, Portfolio A, is Ken French's equally weighted portfolio. And the red line is Ken French's value weighted or market cap weighted portfolio. And the difference between the two, the 4% a year, compounds over a 58-year period, a 59-year period, to a substantial difference in the ending value. So, for me, there were four lessons that emerge. Buy stocks that are cheap by any valid measure of cheapness. Own them in equal weights. Get started as soon as possible because compounding is a very powerful force. And, most important, stay committed to the strategy for the long term, meaning your investment careers and afterwards, because time is really on your side in this thing. So let's get back to the Greenwald challenge. If you follow a simple book-to-market strategy or any of the other reasonable measures, you'll outperform most professional money managers. Why doesn't everyone do it? Well, maybe not everybody believes in it. Maybe people think that it may be very difficult to outperform these simple statistical approaches, but they are not like everybody else, that God has graced them with special talents, and that they're not going to start here. But this is the French formula, quantitative investing at its most pristine form. It's taking a bunch of stocks, it's sorting them on one variable, and it's just dividing them up into buckets, quintiles, deciles, whatever you want afterwards. And that's all it does. And if you could simply do that, you would have a very successful investment record. This is the naive approach. It should be easy to improve upon it, but I think I'm going to hand it over to Jenny, who's going to explain to you why improving upon it is not so simple. Okay.
So, as Judd says, it ought to be pretty easy, right? If you just take one mathematical factor and divide the universe according to it and invest only in the cheap stocks, the market shouldn't really return, what was it, 8.5%. The market should return 18.5%, right? And so the question for us is the French challenge. We take it quite seriously, and we say to ourselves, why doesn't everyone do it? That's a serious question, too, because there's a whole world of people out there that regularly underperform a very simple approach. And our question is, why is that? And they don't just underperform it by a little, they underperform it by a lot. So we think there are really two reasons why underperformance happens relative to what should otherwise be a very easy way to invest. And the first is that in theory and practice are the same, but in reality, they're not. That's Yogi Berra, Albert Einstein, you pick. The second is that we can't help ourselves as humans. As Ben Graham points out, the investor's worst enemy is likely themselves. So we're going to start with the first issue, which is really, how do you take something that in theory sounds terrific and quite doable and mess it up or get it right, and how do you move forward? So we're going to talk about theory versus practice. So in theory, you buy a quintile of stocks, which is somewhere between 400 and 600 names, depending on the French universe and the time frame that he starts in. And what French assumes is that you buy all of them. French does not assume the inconveniences that we all face in the real world, which is that you actually have to pay commissions on every stock that you buy. You have to pay, management fees if someone else is doing it for you. And in all likelihood, if you're buying more than a share or two, you're going to move the price a little bit. So while in theory you can buy 400 names for essentially free at the price that it shows up on your screen, in reality, maybe you can't. Also, because French doesn't differentiate, French just says you buy the whole quintile, you really have to buy 400, maybe 500 stocks. And to do that in practice isn't so easy. Many of the stocks that he includes have almost no trading volume, very little float, and if you really want the benefit of the portfolio that Judd showed you, which was 6 times greater than the other one, which means an equal weighted portfolio, you're limited in terms of how much money you can manage by the smallest name in the quintile. So some of these names are $10 million market cap. And if you want an equal weighted proportion of all of them, you can maybe manage $100 million, if that. So basically what I hope is becoming clear is that even though it seems like it should be simple, maybe it's really not that easy. But you can figure it out. And we think we have, and I'm sure other people have as well. The issue is that even after you figure it out, you still have to confront yourself. You have to avoid all of the biases that as humans, just by virtue of being humans, we bring to the party. So you need an investment strategy that allows you to take theory and put it into practice, and then you need a process that allows you to avoid being your own worst enemy. So I'm going to talk a little bit about our investment strategy. As I said, we start with this idea that at a minimum, we need to try to accomplish what French accomplishes, except that we have to do it after fees, after expenses, and with a portfolio that can actually be managed in the real world. So very much like French, we start with a universe of a lot of names, about 10,000, and we narrow it down to a portfolio that we think we can manage somewhere between 35 and 50, 60 at the most names on a regular basis. So you could call that concentrated, you could call that diversified, it sort of depends. We're a whole lot less diversified than French, a whole lot less concentrated than some other people. For us it works because it's enough so that each name affects the portfolio in a meaningful way, but no name is so dominant that if something bad happens, it destroys your performance, right? So having the right number is just part of translating theory into practice. So we start with this universe, and we basically sort on what is not so dissimilar from Ken French's price to cash flow. We normalize the cash flow, we make some other adjustments, but as Judd points out, it really doesn't matter. If you have a legitimate measure of value and you measure all the stocks according to it, you'll get a pretty good ranking of where to focus your attention. We also look at other financial measures. We care about financial stability. We want to make sure that the company isn't about to go bankrupt. We want to make sure that they generate profits on a regular basis. We want to make sure that they've got stable operations, a whole bunch of other things that we look at, but that we do distill into financial measures. So at the end of the day, we have what we consider to be a common yardstick against which we measure a whole universe of stocks. After we measure them, we get basically a rank list. And that rank list tells us where to start our research efforts. Except that it's kind of, as Judd says, a little bit of cheating, because a lot of our research effort has already been done to get us there. So we know that we've got a very fertile place to begin simply by doing a statistical analysis of a large universe of stocks. So our research then, step 2, is really the research that I'm sure you're starting to learn in this class and you'll continue to learn in the rest of the program, which is how to do fundamental research on a company. So we care that the stocks that we buy have demonstrated to be cheap. We know that because they passed our first screen. We also care that they're cheap based on a sustainable earnings level. So are the earnings that the company has generated in the past something they can sustain in the future? We look at all of the fundamental things you need to understand about a company. What is their cost structure? What are their revenues? What are the cash flows that they generate? How much of it is excess? Do they have enough money to reinvest in their products? Have they made smart capital allocation decisions in the past? Basically, what we're trying to figure out is the company cheap, not just on their demonstrated earnings, but also on their sustainable earnings? So it's really answering the same question. Oh, did I skip this? Hold on a second. I did. Sorry about that. Okay. So this is our research. So the second question is really, are they cheap based on their sustainable earnings, which is just an outgrowth of the first question. Are they cheap based on their demonstrated earnings? And then the last question that we're trying to answer is, what can go wrong? So is there something going on at this company that means even though they are cheap, we don't want to buy it, right? There are a lot of cheap companies out there. Some of them deserve to be cheap. Some of them are probably undervalued. Let's make sure we're in the undervalued category, not in the category of companies where they're sort of the value traps. They'll stay cheap forever. So are there barriers to the company becoming truly correctly valued? Some of the barriers that exist are easy to find. Some of them are harder. On the balance sheet, you'll see a company with too much leverage. But sometimes in the footnotes, you have to check to make sure there's not any additional leverage that doesn't show up. If there's entrenched management, if there are dual-class shares, there are lots of things that can exist that you sort of have to pick apart to find out, is this a company where the management team is out for your interest and the board is out for your interest as a shareholder, or are they out for their own? So you'll see companies where $100 million market cap company, they have a lot of cash on the balance sheet, and all of a sudden they buy a jet for $40 million. And you think to yourself, wait a minute, that was my money. What did what are you doing with that? So you can find these things out, but you have to do the research. You have to check in the proxy, you have to check in the footnotes. Ultimately, you can figure out, is there a reasonably good chance that this company will get back to true value? I'm going to just go back really quickly because I had talked about our measure of value and how it's a normalized cash flow measure. What I think is interesting is this is broken up into deciles, not quintiles, but it looks an awful lot like the French quintiles, right? If you see, it's the average returns broken up by our normalized cash flow measure, but yet again, here's another piece of evidence that as long as you're looking at things on some reasonable measure of value, ultimately, if you buy cheap stocks, which is always on the right in our case, you'll do okay. So as I said, our step 2 is really research to make sure that things that look cheap really are. I'm sorry. And what you'll notice about our research process is you don't see anywhere that we're trying to figure out whether the 10-year growth rate of the company is 12% or 11.5%, right? There's no fine distinction here that's going to make or break our investment decision that requires sort of special, detailed projections out into the future. We're not splitting hairs. What we're doing is we're saying this is a cheap company based on what they earned in the past. There is reasonable expectation that they can recover their earnings into the future on a sustainable basis. And there's probably no big things that can get in the way of that happening. What we do is really a process of exclusion, right? So we start with a big universe, we narrow it down to a smaller universe, which is our ranked list, which we narrow further by our research to a portfolio of 35 to 50 names. And so unlike the theoretical portfolio of French, which has 500 names with a simple buy-sell approach, we have 30 or 50 names, which we buy because they're cheap, because we think they can recover, and we know exactly why we'll sell them. We'll sell them either when the price goes up beyond our assessment of what it's worth, or when something material happens to tell us that we were either wrong in our analysis of the sustainability, or if something happens. The management team that has always made really good decisions with cash and then does something really stupid, like makes a big acquisition and levers up their balance sheet. But basically, those are the two reasons we sell. Most professional investment managers will tell you it's hard to figure out when to sell. We become a little bit attached to the names in our portfolio. We think we have sort of special insights because we've been following them for a while. Our research has been pretty clear that the reality is when the numbers no longer tell you the story that you need to know, they no longer show you the profile that you've identified that you're looking for, move on. Sell the name, find something else. For us, we've got the process. We've always got a list of names that we can look at next. And that's one of the beauties of this systematic approach. We don't have any special favorites. We don't have any children that we like better than our others. We know why we own the name. We own it for as long as it can deliver what we're looking for. And when it no longer can, we're happy to sell it and move on to the next. So let me just... I think what we're trying to get across is the notion that you can take a theoretical approach, which is really the essential underpinnings of value investing, buy cheap stocks. You can figure out how to apply it in the real world, and you can be a long way there. We think just doing that and nothing else is a great basis to start as an investor. You're still left with yourself, and as we know, we're all humans, and until human nature changes, that's the biggest challenge after you figure out what you want to do. Figure out how you're going to do it. So we think it's critical to have a process in place. You have an investment strategy for how you want to invest, and then you develop a process really to keep yourself from being your own worst enemy, to keep yourself from causing the trouble that we all bring to the party just by virtue of being human. So Artie's going to talk a little bit about our process, but more than our process, he's going to talk about why it's important to have a process, because without it, you're sort of like a ship at sea.
Everybody's heard that, you should be fearful when others are greedy. You should be greedy when others are fearful. But you never know how you're going to act until you're in the moment. I mean, we were debating whether to show a video clip. So everybody remembers it. They've seen the movie Officer and a Gentleman. Anybody? Has anybody seen it? We were going to show it, but anyway, there's some naval officers. They're learning how to fly. One of them gets up on a catapult in a swimming pool. Catapult this pod down into the swimming pool. The first person down doesn't have any clue what to do, and he's panicking, and he's going to drown. And the drill sergeant or the master sergeant says, now so-and-so down at the bottom of the pool, he's disoriented. He doesn't know what he's going to do. He doesn't have a plan. He doesn't have a strategy. When you hit that water, it's going to be hitting at like 500 miles an hour. You're going to be disoriented. You won't know which way's up. You follow the bubbles. You follow your air bubbles, and that'll show you the way to keep, the way to safety. So the next person comes up, which is the Richard Gere character, or the Richard Gere person. He goes down, calmly unhooks, swims up to the top. Third person that goes is a young woman who's the only woman in the program, Same thing. She gets out of the pool and says, wow, that's great. Can I do it again? So you've got an example, you've got a dilemma, you've got a problem, you've got a solution to the problem, and you've seen people actually do it. So the third guy gets up there and he's nervous. Needless to say, he goes down and he gets disoriented and tries to do something else, and they had to send the frogmen down to save him. So even though he had been told, and he had seen it demonstrated, when the moment of truth came, he really didn't know how to act. And that's what we've tried to instill or try to incorporate in what we've done, is to develop a process beforehand so that we're making decisions in normal conditions, not making decisions when we're influenced by the minute-by-minute distractions of the market. Recently, the field of behavioral psychology has moved into the investment world, and it's added to the emotions of fear and greed a host of other problems called cognitive biases, and they also get in the way of making rational decisions. But before we discuss those, let's look at those little questions that we had. It all sort of ties together in the end. If you can remember what your answers were. A bat and a ball together cost $1.10. The bat cost $1 more than the ball. How much does the ball cost? 5 cents. Did everybody get that right? Anybody get it wrong? You don't have to admit it if you did. If it takes 5 minutes for 5 machines to make 5 umbrellas, how long would it take 100 machines to make 100 umbrellas? 5 minutes. In a lake, there's a patch of lily pads. Patch doubles in size every day. It's completely covered on the 49th day or the 48th day. What day is it half covered? 47. So all of you got all 3 of them right, correct?
I would say there's about 50%. But there are 50%, which is really impressive.
We're actually going to take these and tabulate it just for the hell of it to see what happens. This actually is called the cognitive reflection test. It was developed by a guy named Shane Frederick of Yale. Before that, he was at MIT. I don't know whether Bruce knew him or not. And apparently, he believes this is more powerful than any IQ test at measuring your reflective system's ability to check the output of your reflexive system. Now, Frederick has given this test to about 3,500 people. 17% of the people he gave it to got all 3 questions right. 33% didn't get any. Now, another gentleman by the name of James Montier, I'm sure there are a lot of people here that are familiar with James. He's given it, now this is scary, he's given it to 600 investment professionals. 40% got all 3 right, and 10% didn't get any. The source of the error is that instead of taking time to reflect on stuff, on the questions, most of us simply react to them. We actually use a different part of our brain to come up with the answers. So if we just force ourselves to slow down, give the more logical parts of our brain time to engage, then we have a much better chance of thinking things through. The problem is when you're sitting at the bottom of that swimming pool and you're disoriented, are you going to stop and think, keep a clear mind, or are you going to panic? You know, the unfortunate thing is our reflexive system is our default system. And that's proven. You react first and then you reflect secondly. In addition, neuroscientists have recently uncovered 2 particular traits which I think are of extreme significance to investors. The first is that we're hardwired for the short term. And the second is we're hardwired to herd. And I think these are a couple of the reasons why value investing works and why value investing isn't followed by everybody. The fact that these cognitive biases are grounded in functioning of our brain suggests how deeply seated, how hard to overcome these responses actually are, and why it takes a concerted effort to protect yourself from becoming your own worst enemy. Self-control over your impulses is very, very hard. I mean, we all know that. You walk by in the kitchen and somebody's just baked some chocolate cookies. Do we defer? Psychologists have found that self-control is actually a very limited resource. The more we use it, the less we have for the next time that we have to use it. So again, what we have accomplished, I think, is we have built into our process ways to help us maintain self-control, sticking to the process. We believe that the key to behavioral and neurological implications for investors are the following. At times we do things that are not rational as defined by economists. Whatever we're trying to maximize, we're not trying to maximize returns. We may be trying to maximize ego. We may be trying to avoid pain. There are a number of biases. The list of cognitive biases is long, and some push across cross boundaries, but the significant points for us is everybody's looking for the perfect investment strategy, and that's one that never loses money, and that doesn't exist, period. Investing is probabilistic. Losses are going to occur at times. If you practice value investing, there will be times that you will underperform. And because our tendency is to avoid losses or to be loss averse, strategies such as value investing or sometimes short-term losses will be shunned. We as humans are attracted to stories, and stories are associated with value stocks are going to be rotten. It's difficult not to be influenced by these stories. There's a million reasons why you shouldn't own the thing. And I think Buffett said, you're never going to find value in a cheery consensus. On the other hand, all your friends are going to be talking about all the great stocks they bought and all the wonderful stories, and you're going to want to join in, and that's the bias of herding. So you're going to fall prey to it if you don't create a strategy that sort of directs you in that way. A focus on the long term is extremely critical. You can't allow yourself to get carried away with short-term gains and forget about the long term. And then finally, we're all overconfident in our abilities, and going back to what Jenny said, it's extremely difficult to acknowledge the fact that in a lot of cases, just a simple strategy will easily outperform you. And finally, knowledge and behavior are not the same. Just because you know how to do it, it doesn't mean that you necessarily will do it. What we've done is we've taken the output or the results and used that as a starting point. But what we've done over the past couple of years is really focus on the process as to how to execute our strategy. And this is a chart that you will see in one of Montier's books. It's a 4x4 grid, but you talk about, ideally you want to be in the upper left-hand quadrant, where you have a good process and you have a good outcome. But if you have a good process, things happen, and there can be bad breaks, which are bad outcomes, but that's okay. You live with that. It's much better than being in the situation where you're in the bottom left, where you have a bad process and you have a great outcome. You're going to try it again, and you're going to try it again, and then eventually it's not going to work, and it could be potentially disastrous. So what does our process look like? We screen, we start with 12,000 stocks, we screen it down, and we have a ranking system. And Jenny didn't go into the precise detail, but when we talk about our common yardstick, French had a one-factor model, and then he expanded it to a two-factor model when he considered market size. We have a multi-factor model. So we rank on a number of different factors and then add those factors together. Not unlike Joel Greenblatt does the same thing to the same extent. His is a two-factor model in his magic formula. So we take the number of factors that we have, and we rank them from 1 to 1,500. Then we add the rankings together and then re-rank that, and we start with number 1. So in that part of the process, it's all statistical. It's all done through the database that we subscribe to, and it's also done by the computer program that we employ. So at the beginning of every month, we run our screen, and they're ranked from 1 to 1,500. We start with number 1, and we start to do our work, and we have a research process that we have a protocol that we go through, and we do it the same way for every stock. In fact, what we do is we use a checklist. which has anybody read the new book by Greenwald called the Checklist Manifesto? Anybody familiar with it? Okay, a couple of people. Greenwald is a doctor. He's a surgeon. And in the book, he's discussed a number of things. Talks about airplane crashes and the miracle on the Hudson and a number of things. But early in the book, he talks about how simple checklists have dramatically reduced healthcare costs and, more importantly, saved lives in the operating room. A simple checklist where a surgeon beforehand will check off a handful of items to make sure that they're prepared for any emergencies or certain procedures are done. Doesn't cost anything and has made dramatic improvements, not only in the United States but around the rest of the world. And he was employed by the World Health Organization to do this. We've been talking about checklists and been using it, a year and a half or so early on before we read the book. But anyway, I think the book adds some credibility to what we're doing. The interesting thing that Greenwald points out is that most surgeons, first of all, they are very reluctant when they first introduced this to use the checklist. I went to, a zillion years of medical school. I'm highly trained. I don't need to use a damn checklist. I know how to do all this stuff. So there's a lot of resistance by the surgeons. But they went back and asked the surgeons, if you're in the operating room and somebody else is operating on you, would you want the surgeon that's operating on you to use the checklist? Every one of them said absolutely yeah. So that goes kind of the overconfidence. You trust yourself, but you don't trust other people. The question is, should you really trust yourself? We don't like checklists. We do, but most people don't like checklists. They can be tedious. They're not much fun. And in some respects, it feels like it's beneath us to use them. But what it does is it allows you to get the dumb, mundane stuff out of the way. You check it to make sure that it's done, and then it frees you up to really, really concentrate on what matters. And in our case, what really matters is determining whether or not the earnings for the company, where in our ranking system it's shown that it's statistically cheap, whether that in fact is the case. Our process forces us to focus on what's important. If Jenny or Judd or I go to a conference, or if we talk to somebody here at school and they talk about a great idea, I'm sure it's a great idea. But if it isn't 1, 2, 3, or 4 on our list at the beginning of the month, we don't put it in the portfolio. Period. The benefit of this is it's systematic, but it's highly efficient. We're only focusing our attention on the names that are ranked the highest. We don't worry about the names. We go one by one. We start with one. We do the work that Jenny talked about. If we don't see any reasons why we shouldn't own it and there's room in the portfolio, then we buy it. If we see something that's wrong, we move to the next one. We don't try to figure it out. Because we've done enough testing and I'll talk about testing in a minute, we've done enough testing over the past 2 years that we know that we can go down, not too deep, but we can go down our list and still the performance doesn't degrade. We have another advantage, though, by using a statistical ranking approach. Because we've boiled the process down to a handful of very testable ideas and elements, and the ranking system is so purely quantitative, we've been able to simulate this over the past 20 some odd years. And how we've done that is the program that we use, or the software program that we use, has a back testing function. So we were able to back test our strategy and test a number of things, and we test a number of factors. We tested different holding periods. We tested, help me, what else? We ran so many tests. How many tests do you think we've run over the past?
About, a lot.
We run a lot.
We've tested factors, we've tested combinations of factors. It sort of depends on how fine you want to split it.
But what we did is we started with value, and we said, okay, let's see if we can use the program and to recreate what French did. Start with the market, the book, and see that. And then we really said, well, if you're in a quintile and the quintile returns 15% of the year over the years, some of the stocks are going to do better than 15% and some are going to do worse. So if you could identify the winners or avoid the losers, you should be able to do better than a quintile that already does better. And we played around with it, and we thought, how are we going to identify the winners? And then we flipped it, inverted it, and said, maybe it's easier to predict the losers. And the way I like to say it is, if you put two people together and they're the same age, and one person exercises every day and looks to be in reasonably good health, and the other person drinks 2 pints of vodka a day and smokes 3 packs of cigarettes, and you know that, who do you think has a longer life expectancy? Which one would you avoid? So what we did is we looked for factors, and we put into our factor test, and these are the factors that we measure on, are things that we think indicate unhealthy companies. So certainly the financial leverage that they employ. We look for the market cap size to some extent. We look for whether or not
positive or negative.
What's that?
Market cap.
What do you mean, positive or
I
negative?
mean, is it too high and you don't do it, or
No.
It's really a liquidity.
It's more of a liquidity. We want to be able to buy within a certain number of days, so we don't move the market. We look at whether the company is a good company. We're not looking necessarily for great companies, but we want to invest in companies that have earned at least their cost of capital over a period of time. We look at companies that have a operating history, more than a year, several years. We look for companies that have made money in the past, and those factor in. But the great thing about it is I don't know how many took the applied value investing class, but we always had these discussions about what multiples do you put on a company. Well, it depends, because no two companies are exactly alike. The quality of the business is different. They may be a different place in the cycle. They may have reinvestment opportunities where somebody else doesn't. And how do you know which is the better deal, so to speak, or which is more valuable? A better opportunity, better value. Our ranking system does that, because automatically right off the bat, we know that this is the best opportunity, this is the second best opportunity, and this is the third. We're measuring everything across equally. We use a normalized earnings to enterprise value is one of our evaluation methods. So it makes it very easy. But the great thing about the back test is, one, it's certainly helped us refine and create the portfolio that we have. But secondly, and more importantly, it gives us additional confidence in the effectiveness of the durability of the approach. We started managing money live April a year ago with this strategy. And does everybody remembers what happened in 2008 and early 2009, all the uncertainty. I can honestly say, and I think all of us would say, that if we had not done the back test and not done the work and seen what the portfolio would have acted like over the past 20 years, it would have been extremely difficult to invest on April 1st, which is what we did. So the back test gave us confidence to, A, get started, but B, it focuses our attention on what really matters. And that, I think, is focusing on the long term. In essence, what we've done is we've made a pre-commitment. We said, this is our strategy. This is how we're going to execute the strategy, and we're going to stick to it, through thick and thin. A great investor did the same thing. Sir John Templeton, years and years ago, during normal times, would look at companies and he'd create a shopping list, and he would say, okay, this company is worth this, and if the market price gets to this level, I would want to buy it. He would immediately put an order in with his broker, which may be well below what the current market price is. The reason why is he wanted to make a pre-commitment. He knew that if the market went to heck, that he probably wouldn't have the guts at the time to invest. But he knew that if he made that pre-commitment, and he said, well, wait a minute, 6 months ago I said IBM was worth X, and today it's worth X. What's changed? Why wouldn't I? I think the power of having a pre-commitment, or the power of having something there to rely on or fall back on, is critical. And a lot of people, they have a long history. They've been doing it for a long period of time, and they have a process ingrained, in their head, so to speak. In our case, we actually have it on paper. And lastly, what I want to show you is going back to the French challenge. What we did is we've overlaid two different charts. The red line is the French cash flow to price equally weighted, which is the chart that we showed earlier, except it didn't show the rebound which happened. And then the blue line is our simulation for our strategy since 1983, and that's where the data starts. And the lines are almost the same. The difference is we're charging management fees. We're paying commissions. We factored in slippage. And we've developed a portfolio that you can actually manage. 50 names is manageable, 400 names is not. So we think we've met the challenge. And we think, at least for us, it is an intelligent way to go about managing money for us and for our investors. So that's it. But we're more than happy to answer questions. Yes?
Portfolios that are equally weighted, how big is each position?
About 2.5% to 2.5% at purchase.
Dollar values?
It depends on the market. I mean, if the 2.5% of the portfolio is an average initial position size, obviously that grows and shrinks based on what happens to the price.
It purchase, it's two point, they're about, yeah. And the reason why we use that number, the portfolios that we simulated have 2% positions. So that's one of the great things. And that helped us in the portfolio management by doing all the testing. 2% wasn't some random number that we selected. I mean, we looked at 3% positions, we looked at 5% positions, we looked at 1% positions.
So we started with the idea that we wanted to have a manageable portfolio of about 50 names. Well, 100% divided by 50 names leaves you with 2% positions, which is sort of the right number in our mind.
And, if you go back to your statistics course, 30 seems to be a magic number, that if you get 30 names that are diversified, then you get adequate diversification. So we use that as a starting point. Yeah. Yes, sir.
What's the average turnover?
The average turnover.
It's our expectation of the bias times will hold it for a year, at least. Obviously, things happen, and if the price goes up a lot, we can't justify holding it. We'll take the short-term gain if we need to, but we'll hold it for at least a year unless something big happens.
But that's your expectation, so you back test it. So what has it been in actuality? What it turns out?
So it's probably a year and a half, really. Back testers are great in a lot of ways, and for us, the importance of a back tester is that it, as already said, allowed us to do a lot of factor analysis. But the reality is, overcoming yourself as your own worst enemy is really tough, and having a back tester is a very powerful thing for human nature, and it helps us a lot. So that being said, everything that a back tester shows isn't always exactly how it would really play out, and you have to go into any look at a back tester with a little bit of a grain of salt.
To add to that, the one thing we've learned when we first started talking about the barge pole front, it was punch a button, buy a bunch of names, hold it for a predetermined period, rebalance, And we thought, well, we can make a bunch of money and not have to work that hard. The problem is you can't necessarily do that because, if you buy a name and it runs up 100 and 150% in the first 6 months, do you want to run the risk of round tripping it? If you don't have a sense of what it's worth and it gets to what it's worth. So there's actually one of the things that we've learned is although we thought we were starting with a very statistical, quantitative, sort of almost robotic approach, there's a lot more human intervention in it than what we, I think, originally envisioned. That being said, none of the moves are made unless they've been statistically or they've been tested on our part, or there's some sort of business reason why we do it. For instance, in our back test, we have a profile of a company that we like. We like companies that have demonstrated earnings, that don't have a lot of debt, that have excess cash, yada, yada, yada. Those profiles can change during the course of the year. If a company announces, if they have a lot of cash on the balance sheet, and they announce that they're going to do an acquisition for cash, we know through empirical evidence that most acquisitions don't work out, especially for the acquiring company, that it's value destroying. Furthermore, let's say they use the cash and they lever up some to finance this transaction. Well, the company that we bought isn't the same company that we now are potentially going to own. Rather than
There's a risk associated.
There's a risk associated with it, and we think the risk is greater that it's value destroying. So what we will do is, in most situations, we will sell that name if it's during the course of the year, and we'll go to something else that matches our profile.
You ever not sell a name?
Yeah.
How do you decide that?
Well, you want to tell the TRA story?
The other interesting thing about investing with a very statistical approach is that you find yourself brought to areas that are generally either unloved or there is a broad consensus that there's a problem. Healthcare today shows up as cheap on a lot of screens. And in the not-too-distant past, fertilizer companies, I don't know if anybody follows fertilizer.
Exciting businesses.
It's boring, but there are a lot of players. They had a huge run-up in the commodity sort of bull market, and they all got absolutely decimated in 2008. They had great balance sheets, a ton of cash, and there's a lot of consolidation potential in the business. And based on our analysis, every single one of them looked like a great buy. We owned a lot of them, and it turned out that one's bidding for the other, and they're all announcing that, of course, none of the offers are sufficient, and they're all moving around trying to figure out how do they afford these takeover attempts. And as an investor, it's a legitimate question. Maybe, really, truly, the offer for Terra wasn't a fair and full offer. But maybe the management team really wants to keep their job. And so you have to really figure out carefully what's the offer, what are they looking to do to work the offer, and what are the realistic prospects of another bidder coming in. Or are we just going to languish here, fend off the offer, and have the stock price go down? So Terra is an example where, was it Terra announced they were going to, or no, it was
Terra was going, CF was going to buy Terra.
Who announced they were going to lever up?
And Agrium was going to buy CF.
Right.
So you've got this three-way dance going on. And Terra then announced that the CF bid undervalues our company, and we're going to do shareholders a favor. We're going to pay out a special dividend of the cash, which the cash was significant on the balance sheet, and we're going to borrow some money to pay down
the debt and pay a little bit more to the shareholders.
They were going to lever up, in essence, to make the company not quite as attractive. Well, right off the bat, we're saying, this may be a corporate governance issue. Are they really doing what's in the best interest of shareholders, or are they just protecting their own job?
So the answer, though, Bruce, is we do the math.
So we did the math. And what happened is we had sort of said, well, they haven't paid the dividend out yet. There's a lot of activity in the space. We'll monitor it and see. And last week, a company from overseas took them out at a higher price than, and we sold it that day. So we did wait in that case. But we're constantly looking at what's going on. Again, the key is we want to own what we intended to own. If it changes, we're going to move on. If the profile changes, we're going to move on. Materially changes, yeah. Yes?
You mentioned Joel Greenblatt's magic formula before. I was wondering if that's influenced what you've done at all. And then
I'd be lying if I said it didn't. Of course it has. I think it's influenced everybody. He does it a little differently. He has a two-factor model, which one is based on cheapness and the other's on quality. And where we differ is his, at least the version in the magic formula, is his is based on trailing 12 months earnings. We use normalized earnings, so we use a normalization factor. His is truly, you buy them at the start, you hold it for a year, and you rebalance it after a year. We do a little more than that, but yes, we took his
We also
research.
tried to replicate.
We tried to replicate it too.
And by the way, we're a little suspect.
No, we're not. No, we're not.
You also take a look at, you can go to something called formulainvesting.com and invest in it. It's a real bargain because I think they charge 1% a year, including commissions. They hold, I think, 24 names, and they use this two-factor model to weight them, and they weight them equally. Which means that one of the first things we did when we had the capacity was to test it. And we probably didn't get his equation for value or his equation for return on capital exactly right. And after we put the two factors together, we said, well, what happens if we just use the cheapness factor? And the returns went up. So we thought, well, maybe this high return on capital isn't usual and it's stacked up. But I do love the fact that they publish a simulation of their returns on this thing. And they've got it from September or October 1st of 99 to September 2009. And of course, I'm not saying this isn't the case, but we outperform by about 4 or 5% a year. So we like what we're doing, but he has opened up the reasonability of this as an investment.
But again, the major difference is his reliance on trailing 12 months earnings. He's just buying it, at least in the strategy articulated in the book. He's not going and doing any additional research to see if the numbers are truly reflective of what's going on. There are data hygiene issues. We look at that to make sure that the numbers that is in the database is actually the numbers that are reflected on the financial statements. Just to scrub the data, and then we do a little bit more. And again, it's that trying to identify, the losers or try to avoid. For instance, if you follow the Greenblatt method or the French method, how do you incorporate off-balance sheet liabilities?
Well, how do you incorporate leverage, Gary?
That's right. He doesn't. We do. And see, that's a great point because in most cases, something has happened to the businesses that we own. And after running a business or being involved in a business for years, when you have a problem, it takes longer than a week or 2 weeks to solve that problem in most cases. A lot of times it takes months, if not a year or so. And so if you don't have the financial wherewithal to sort of, be able to stay the course or stay in business until you correct it, you can get taken out of the game. So the stocks that we own are financially strong so that they can have time, have a long enough runway to correct any problems that have occurred in their business. And of course, we're always looking and answering that question, is the problem temporary or is it permanent? Which is the important, and that goes back to the important thing to focus on. Is it a temporary problem or is it a permanent problem? Yes, sir. Oh, absolutely.
So what do you do in those cases?
Yeah, we've got a great answer to that question. Healthcare is one answer. I mean, Jenny can tell you what we did, but and this is again sort of the human intervention part of it that you can't simulate. Do you want a portfolio that owns, that 75% of the portfolio is in healthcare? What did we do?
I mean, in our case, because we really do have sort of the step two, the other thing we've been able to test is sort of how good our ranking is. And our ranking is actually, already says we stay within the top. But we know we can dip down. So if we own enough healthcare, we can move on to the next. There are enough interesting investment opportunities for us that we will be overweight in the undervalued industries, and we'll probably have more than our fair share, but we will not have a 100% healthcare portfolio.
What's the limit?
That's a tough question. Second to when to sell is what's the limit?
Well,
It's 35%, 40, at the most 35, depending on the industry. Healthcare is a big industry.
Healthcare is a big industry,
So
and
we really divided it up into sort of smaller bits of healthcare, managed care, pharmaceuticals, facilities, and own the best names in each.
yeah, what we did is we said, well, you never say this time it's different, but there was political risk involved in that nobody knew, what the outcome of the political debate was going to be. So, some of the businesses, if the legislation was onerous enough, potentially could have no business. So we said, what can go wrong? How much would we be willing to invest and lose all of it? And then we used that as our starting point. And then we said, well, we're not really sure about it. Each particular name, so rather than, back to the portfolio size question, rather than have 2% positions, what we felt like was the smart thing in that case was to buy 1% positions, to have a bigger basket in the healthcare area. Now, typical, what we should have done was follow the model, because we would have done a lot better than what we had done. The names that we selected have done extraordinarily well. But we're okay with it.
That's a risk management question. I mean, that's really a portfolio management, risk management question. And what's the exposure that's right for your investors? And it worked out this time, but being conservative in our mind is sort of the right way to go.
So you talked about checklist earlier, and I'm not asking you for secret sauce, but maybe a real basic checklist that a reasonable investor should go through.
Yeah.
If you go back, you can even go back to our research at the beginning, the simple research checklist. I mean, these are the 3 questions we ask ourselves, right? So if you have a systematic screen, you already have the answer to question number 1. As long as the data is correct, you check the hygiene, right? And then question number 2 is, can they sustain? And what we look is, are the trends. We look at the financial statements, we look at kind of the margins, the cost structure, their balance sheet. Are the earnings that they've achieved in the past sustainable in the future? Is there a hiccup? When can they recover? But really, you need to read and understand. You need to understand if it's cheap and by what measures. You need to read and understand the financial statements. You need to check the footnotes.
Can I ask a question about that, Jenny? Is the second one a number for sustainable earnings, or is it a yes, no to the first question?
It's really more of we start with demonstrated earnings, and the question is demonstrated a good proxy for sustainable? So it's
a yes, no.
It's kind of a yes, no, but sometimes it's not, right? Sometimes sustainable isn't quite what they've earned in the past, but it's still cheap because investors tend to overcompensate. They tend to overpenalize companies. So maybe they're not going to earn $100 million in the future. Maybe they're going to earn 97 or 95 or 85. And oftentimes what you'll find is that a company whose earnings have gone down will be cheap, not only based on their historical earnings, but even still cheap on lower future expected earnings.
Yeah, or a case where could be a flaw, and what we're looking at is something ranks as cheap, but they had an extraordinarily good year or a good couple of years. And the earnings have been really good, but we don't think those are sustainable in the future. So we'll discount those earnings to determine whether or not they're sustainable or not, if that makes sense.
Or we'll just assume that they're not. We'll take it down a couple notches and say, is it still cheap?
But we want the checklist to really focus on, again, does this company meet the profile that we want to invest in? So we're looking at other things that aren't reflected in the statistical financial information that could impact the enterprise value or the earnings power of the operation. Off-balance sheet liabilities is one. Another one, which is a corporate governance issue, but it has to be an extraordinary case for us to invest in something where there's a dual class structure. We just do not like the fact that you can have super voting for a limited equity interest. Yes.
Do you spend much time meeting with management?
No.
No.
No. For those of you that are fans of Montier, he's a big advocate of not meeting management at all. More information is not necessarily better information, and sometimes you can become enamored with the management teams. You meet them enough, and you personally like them, and you become friends, and you want to believe what they're telling you is true, and maybe the numbers don't reflect that, but then you start to rationalize it because Joe's a great guy and he's going to do the right thing. We go by the numbers.
We really do believe that everything important about the management shows up in the numbers.
Yeah.
I mean, but it also shows up in like a news story. If they're real dirtbags, you'll see
Yeah,
that
we read the conference calls, or we'll listen to the conference calls, not so much because we're listening to the stories. We're trying to get indications of the biggest risk. If you buy cash-rich companies, the biggest risk is capital allocation risk, that they do something stupid with the cash. And so we're constantly monitoring to see if they have an acquisition strategy, what that strategy is going to be, or if they're going to. We looked at one company where company showed up is cheap, but you find out that they just built a new corporate headquarters, and the CEO had built an apartment within. And this is like a 35-story office tower in Dallas. He had built an apartment for himself and for his wife for as long as they both lived. Is that really a good corporate governance? I mean, do you want to be in a situation like that?
If they're going to do that, what else are they going to do with money?
Yeah.
Why don't you take one more question?
Absolutely. Okay, well, maybe two more. Okay. Yeah.
How important is it to you to have a clear diagnosis of what the market is missing, why they're missing it, or is it enough for it to just be cheap relative to your assessment of value, if you can call it a banking?
Okay, look, in applied value, the class, we're going to do a lot of diagnosis, understanding what the market thinks, and why you put this alternate hypothesis, and that's really important. But there's a limit to we basically need to understand why it's cheap. And for the names that we buy, it tends to be an earnings hiccup. It tends to be something that's happened, kind of get in the way of their normal performance. And more often than not, our investment thesis is it's been over-penalized, and we believe for these reasons it's reasonable to expect they'll recover. And sometimes it's like a sentiment issue. Everybody knows that Obama is going to legislate away all profits for the entire healthcare industry. And so it's not that it's not important, it's just that they're kind of obvious most of the time. And we're not looking for those unusual situations where if you back out their ownership in this public company and you take off the cash and you do this and you do the 16 different things, all of a sudden, it's cheap, but nobody would have noticed it. That's not our investment strategy, but if it is your investment strategy, you need to know it, and you need to know it very carefully. For what we do, they're just not that hard to figure out.
We also, because of the ranking system and because we have a record of what we're actually working on, if we skip a name, we follow the name. We have a log where we write, we've got a sheet where it has all the information on the particular company, and if we pass on it, it's usually because Artie said this is going to happen, and we follow it going forward. And, most of the time Artie's wrong. Most of the time the model's right. So we've become really reluctant to exclude things because of our personal bias.
Artie, I want to stop you right there.
Yes.
Time.
Okay. Thank you very much. they didn't want to. They wouldn't do it.
Oh, they didn't want it? Oh, okay, that's different. Okay. Hasta el jueves.
Llevemos they have a thing about blank
Hey, Kevin, did you give me John's evaluations? You may have, but I just didn't remember. Okay.
I did.
I'll double check.
They say you guys moderating.
I thought that was like a final.
There's some kind of final class where they decide.
I don't know. I think at first she said to give it to her by 6, so she probably already. Hey, so where you going?
That was what was there.
Oh, you're the town office guy? No, no. I just want to come on Thursday. On Thursday. I should do it. Officially, I have my office hours. No, no. I mean, it's next week. We got to see. Thursday, we got to see. Next week, we got to see. All right, let's go right now. Well, we did a terrific job, but we did not get to the really subtle. You always got to stop for a fact. You can't stop for show up. And they start getting that somebody who does update his what to do. Lots of rents. Los Angeles outperformed by 3% a year.
Right, he didn't ever use
Simple market. The which is less than it's because I have variable change.
Actually, too, that's what I'm saying. I just want to make sure it wasn't right.
That's really in this game, is
It's near my bed. I have
Are you guys just going home now? Or are you going? Because I got to talk to this kid for just going now. Or just go. The answer is very simple. We're just going. All right. So it was a pleasure meeting.
But yeah, I mean, I just
And, come on, let's do it.
and it's twofold, right? It's
really, my schedule's getting to half the way. It's not too.
And then they were cheap, and then nothing changed, and like the end of the cycle. So, you know, there's national investors. Classic value trap.
Very useful questions. I got it. That's my next thing. I want to deal with.
And they basically have.
That's a simple upgrade or downgrade away. We're dropping it up. Right.
And then a. All we did, so I showed you the quintiles of our demonstrated earnings yield. So basically, what the back test did is only demonstrated earnings yield. So what that means is data scrubbing errors weren't corrected, and all of the things that we're talking about now, like oh yeah, but it's not really, you know, it's really a master limited partnership and it's the open system. All these weird things, and it's not really the earnings because they aren't taxed. All these little quirky things that we would correct for, we didn't even correct for. We actually know that if you just did that, you can do it. But the reality is, either we're stupid enough to believe we can do better, or realize that like investors don't know that there's a product managing the computer, and it's not just kind of spinning out random things. But there's for every name that you know, audio, I would say, we're not going to buy it. I know the fact management team is the company that bought the Kearney, we wouldn't buy it. The company that the bought the apartment actually did. I know there's a company where it's called, we call it our set yield. So we've demonstrated earnings part of it. We call it our sustainable earnings part. So we said it's faulty because it didn't really, you know, it's a bad product and blah, blah, blah. Anyway, that tripled. And so, you know, the reality is the back test is just the most basic testable elements. And in many ways, the benefit of the back test is overcoming our own biases, reminding ourselves, guess what? We may think we're geniuses if we're interesting and we're doing this, and that's why we try to remind ourselves that maybe we're not such geniuses, right? That maybe the answer was we should have gone. And part of having a research checklist is that you don't say, but I don't like that. I think that plastic rubber stuff makes your feet sweat and it's nasty, right? So I'm not going to buy that. But that's not the important part of the investment decision. What's important is the financial characteristics, financial profile, earnings, and sustainability of earnings, and valuation. Those are the things that are important. But like there's a company that does floors, and they take deposits. And so the cash balance isn't really real. So that's but in reality, because when you actually evaluate the enterprise value, it's not cheap. So there's good and there's bad. There's things that would be in there that we would never buy, and there's things that we probably should have bought. And that test more than anything else helps you appreciate sort of hesitation. It's really hard to hold a journal when you're alive. So having that you know what, we hire, no, I mean, our software is someone off the shelf, and then all of our stuff we hire directly to. I know, you see this one. I missed you every time.
How do you record keep? How do you keep all those records? Like this daily, like journals. You just have a massive Excel sheet, like information. So a new Excel sheet is like your top 1,500.
Oh, no, that Excel sheet, imagine I forget.
And then you like Marty's like I hated this thing 6 months ago.
I have every name that we would have bought.
maybe we just didn't get the full story. But they were interesting too, especially some of the rebalancing stuff. In weekly rebalance, they sort of committed to move a certain percentage every week. Interesting.
There are these guys in Atlanta, which is really interesting. They actually, they ran like a human resources company, so they had money to work with their own and didn't find any managers that they wanted. So then they had a statistical background. This guy's like a change something. So he did all this machine learning. He took the entire S&P 500 and the returns, and he did this basically reverse engineering stocks that generates higher returns. What are the characteristics of that generate low returns? So how do you make 5 good stocks money? And so whenever you do machine learning, you run the risk of sort of data mining and overfitting. And are you really finding things that are useful, or are you deciding that like action? Great examples. And so they came and what was so funny is that they came from machine learning, reverse engineering. We came from what actually makes sense from the biggest standpoint. You can buy cheap is better than expensive, quality is better than crap, and financial leverage and operating ability, all these other things matter. And I would bet that our models are not. They are, and I've read ever since then. Do they sneak into my office and actually copy what I'm saying and write it themselves? Because and so what's really fascinating is to find two people who are similar in so many ways. Now, I think that they apply some business judgment, and if their data had come back saying that butter and Bangladesh is what matters, they probably would have accepted that. And it's reasonable. But they're smart guys, and I think they're doing it very systematic. And I don't know how doing any research. I mean, whatever happens, I mean, they would never admit it. I don't know. Like Al tells you about, Rice Krispies. But yeah, no, whatever happens. And the reality, I mean, I don't know what they own exactly, but I've looked at the sector index. And that's I think the things you do that matter, you don't get too big. You can manage $3 billion, but can you manage $30 billion? Because you really either have to own or you have to take care of it. Whatever you do, I think at some point you do start degrading the power of your process if you try to manage too much money. Unless they're all huge companies and that's what you're drawn to. I hate to bash just somebody on your position to finish this thing at 7:30.
I have this card somewhere that the guy who runs it.
Will you?
Yeah, just give me your email and I'll find it sitting somewhere on my desk.
I'm interested.
Yeah, he was great. Really.
What did they come for?
They were looking
Chris,
for
it's
people.
good to see you.
Yes, me too.
Tell your dad.
I'll tell my dad and my sister.
Tell your sister Caroline to sign.
Caroline
Dobbs, actually, not Wallace.
Okay.
Where is your sister?
She lives in the West Coast.
Take care. Great to meet you.
Yeah, she was interested, in advertising. Well, she had a classic good fan of all of her shows, but she ended up at the so she's possibly, but I'm not sure. She was at the ad council almost a year and a half. She's happy. She looks at a lot of it. Thank you so much. Take care. Oh.